We work in the equities market, and so what we are is a market where all of the investment banks and proprietary trading firms and hedge funds, they interact to actually trade. And so the equities business is the most highly automated of any of the electronic trading businesses. So we'll talk generically about electronic trading, but effectively what the equities market done has gone to, some people probably say it could have gone to extremes in terms of electronic trading. And most other instruments that you trade, if you look at things like FX, is probably fairly automated. And then you get into things like fixed income and swaps, which are far less automated. But the things we're going to talk about show you how far electronic trading has gone and can go. And then some of those things are being adapted for use in other markets. Part of the reason why what we do is, I think, is an interesting story. I spent many years working in technology in risk management, trading, etc., and working on trading desks. And a lot of the usual suspect investment banks, Deutsche Bank, CSFB, these sort of banks. And then on looking at this, what I saw, I originally came from a sort of technology background, went into the derivative sides of things because I thought you really need technology for that. So that was great in the early stage of the career. But then when you start to look at electronic markets, you look at something like equity trading and you think that's fairly simple, but when you really get into it, it's actually a very interesting modeling proposition, technical proposition, and an entrepreneurial proposition as well. So BATS started in the US in 2006. And in Europe in 2007, 2008, and this is dollar billion turnover per month. And just to give you a sort of context of it, number 6 and number 18 are our current US operations. So turning over somewhere in the region of 450 billion a day in equities. Now, when you talk about derivatives, sorry, that's a month. When you talk about derivatives, people often quote enormous numbers. That's because you can pay across the counter, $100 and have a derivative that's got a notional risk of, say, $1,000 or $10,000. When you talk about equities numbers, it's the real amount of money that shifts, because when you buy 10 Vodafone shares and that costs you X, you really have to pay that amount to actually get those shares. So this is real, genuine turnover. The blue numbers, Direct Edge, the two Direct Edge books, are two US books. We're in the process of going through a merger with these guys. So that will make us just behind the New York Stock Exchange. And the New York Stock Exchange is number 2 and number 4 on this. So the New York Stock Exchange is the biggest overall in equities. We'll be borderline, be just smaller than them. We'll be bigger than the NASDAQ. And this was a firm that was built out of electronic trading, and it's 7 years old. And so, the bit I run is number 9, and we're the number 1 exchange by turnover in Europe. So, and we started it 5 years ago. So this, to me, as I say, we're going to talk specifically about the nuances of electronic trading. But it's also somewhere where people can be very entrepreneurial, because businesses don't, you can go and work in the big banks and have very interesting careers with those. You can also go and work in the hedge funds. You can also go and work in proprietary trading groups. You can also create markets, create financial markets as well. So I think the other thing about this is that we're heavily tech orientated. We run the European business with 60 people. So we're number 1 in Europe in 60 people. Some of these big exchanges have probably got 60 people in catering or drivers or whatever they need. It's just a very, very scalable, very automated business. And this is a quick picture. These, you may be familiar with them, you may not. You probably have heard of the FTSE 100 and the DAX or the CAC. But this shows our European footprint. So in many of these markets, we're 25%, 30% of the trading market in these, and we only started 5 years ago. So when we come to electronic trading, we just ought to work out what we're talking about first. So this is Novartis, a stock, and here what we have are bids and offers. So basically what we're saying is these are people who are willing to buy from you, and the best price that someone's willing to buy from you is 71.65 in Novartis, and the best price that if you want to sell to the market, if you want to buy from the market, the best price is 71.70. So this is what's happening in electronic trading. Effectively, you're creating an order book, and what this is doing is showing you the best, how many shares are available at which price. And so it effectively spreads away from this price. So you see this price is worse than that price. So if you were selling to the market, i.e. it was buying from you, you'd want the best price here. And likewise, this is the offer side of the market. So so this is the way the majority of markets operate in the equity sector. The other thing to note here is that was all done. Well, that was all done in 2200ths of that's 2200ths of a second. Yeah. So the speed this is being done at is that we can trade at 100 microseconds, so 10,000 times a second in a stock. So when it's running flat out, it's blisteringly quick, the equities market. And again, when people start to look at, people show you Reuters screens and things, you can't see it. You can't put it on a Reuters screen because it would just be a blur. And so it really is a very high volume processing problem. And I think in the US, in the 2008 financial crisis, we processed, in one trading day in the US, we processed over 1 billion trading messages from the market in one day, which I think was probably an exchange record in terms of the number of trades that were going on. Electronic trading, what are the skills that it brings together? As you might imagine, trading and risk management are important, and it's really working out how you're going to trade. There are lots of different ways of trading. What I was implying there is typically called market making, where you're making two sides of a market. You're buying at one price and selling another. There are lots of different other ways of trading. And you have to also start to think about things like how do you want to allocate capital, because you'll be trading in lots of different stocks all at the same time. How are you actually going to allocate capital to which bet, and how you're going to manage risk, because you're continually buying and selling, and you're holding inventory. Now, if you're holding inventory and a market's going up, that's quite good. If you're holding inventory, but if you've sold inventory and the market's going up, you've got to buy back to cover that, so that can be bad. So all the time, what you're trying to do is work out dynamically how you're managing this risk. There's a lot of maths and stats. You're creating models which are really often for market makers or people in short-term arbitrage, are short-term prediction models. So again, what you're trying to balance there is the accuracy of the model. How much effort do you put into sort of managing sort of stochastic variables, but the flip side of that is you've got to act very, very quickly, because if you're trading in under a thousandth of a second quite regularly, you need something that can calculate very quickly. Computer science, I mean, it's really cross-discipline optimization. The people working on these sort of trading programs, it's very efficient code, so a lot of it is still C++, because it's the fastest sort of coding environment. But it's also about how you actually manage the applications themselves, because if you think about it, the optimal way to actually have model an individual security, so an individual share, is to have a model for that individual share. The trouble is, I mean, we regularly trade about 2,000 stocks. We've actually got about 10,000 available for listing. So it gets mighty complex if you're trying to optimize it for the model. And then you want to update some sort of global variable like interest or interest rates or volatility. How do you best manage that? And just as important are the data sets. A lot of the data sets you're looking at are market data that's coming in real time. So you're not only monitoring what's coming in real time, but a lot of it's about correlations. It's which shares tend to move when others move, or are they correlated to other things like the futures market or the oil price, and so that's what you're doing. You're working out a lot of data. The application infrastructure is important because it's no good just writing the program. You've got to tune everything. So people are tuning the ports on the boxes, they're tuning the disks, they're tuning the memory, they're tuning every part of the I guess application infrastructure, and then physical infrastructure as well. So people are always after the fastest equipment, the fastest comms. People are looking at microwave links between buildings and countries. It's really people are often after that sort of physical infrastructure edge. And then also there actually is behavioural psychology. I bet there are no psychologists in the room, are there? But it's actually pretty important, because in the end, the market mutates. So even if you've managed to do a fantastic statistical analysis that gives you something that's very predictive in the short term, when you start trading, you affect the market. You affect the market itself, and so the market starts trading differently because of your actions. That means eventually your model goes out of date. So back when you think about the modelling side of things, what you're always trying to do is actually create models, but you've got to be able to adapt them, and the speed with which you can adapt them will dictate the success with which you can work, because it really is a sort of a very much an adaptive model in terms of what's happening in the market. And as I say, often this element of it defines how deep you go in terms of the stochastic models you use as well. If as we're going through this, if there's any questions, just please shout out and let me know. So a lot of you would have probably heard there's been quite a lot of debate in the sort of trading press around high frequency trading. Now, high frequency, people sometimes say, oh, that firm is a high frequency trading firm. That really is, if you're looking to get into this or you're interviewing, refer to it as a set of techniques, because actually it's lots of different things, high frequency trading. It really is that the common denominator is you're able to trade fast, and that's about it. But what the highest volume is coming out of market making or liquidity provision. And that really is people making money out of making a two-sided market. So they're making a bid and an offer all the time, like old market makers used to do, like people standing on a trading floor used to do. And so if they buy from someone, typically they're moving down their price. But what these guys are doing is not only doing that, and they're not only looking at the demand in that individual stock, but they're saying, okay, the price of Microsoft is correlated to the price of Apple, so if Apple starts moving, I might want to start moving my Microsoft prices as well, even though I haven't had any trading in that. So that's what it's continually doing. And then what it's also doing, that great big list of exchanges, certainly the American ones and the European ones, often there's multiple venues trading exactly the same stock. So you've got an awful lot going on, because what you've got is you're not only market making just on one market, you're making a market across maybe 5 or 6 markets in the same stock. So you've got a lot of correlation going on across the markets. You've got a lot of people trading with you across markets. And also on the other side of you, you often have got people who are maybe having other trading techniques trading against you. So they might be looking at how you trade and adapting their strategies to reflect that. So the other types of areas where you tend to see this are things like index arbitrage. And so what typically those sort of trading firms are looking for is the difference between an index, so something like the FTSE 100, or a product reflecting the FTSE 100, and their component securities, because fractionally these things often go out of line. Now, some people take much longer term bets on that, but a lot of the high volume electronic trading is about spotting those discrepancies and then putting on trades to exploit that. Statistical arbitrage is back to the type of event I mentioned earlier. So if you've typically seen a correlation in the trading situation that you're looking at, you've typically seen a correlation of, for argument's sake, 0.8 between two stocks, and they're suddenly trading at 0.6. Why has that happened? Is that because there's some market news in the market that has actually said, actually there's a fundamental reason, iPads are catching fire or whatever it is, that there's a permanent dislocation? Or is that just trading volume in the market? And have you actually got a reversion back to that correlation going on? and can you trade that reversion? So that's what stat arbitrage is. And then the other side of this is that it's not just market makers and proprietary trading. Is what happened? I mean, this is a business that's moving on sort of every year. What happened about a few years ago was that many of the firms that were very good at this were US firms who'd honed their skills in the US market, came to Europe, and on the other side of the street were people using algorithms to actually work trades. So if you happen to be working as a salesman or a sales trader in an investment bank, you might have a big fund that would give you an order, and what you would do is you didn't really type that order in or didn't phone that order into a market anymore. You typically put it through some sort of algorithm. Now, many of those algorithms at the time were very simplistic. So they would say, right, I need to do 1,000 shares. The fund managers told you to get it done this day, and you might chop it up into slices, so you were trading every half an hour or every 5 minutes or every 10 minutes. Now, if you can imagine what people on the other side of that who are used to picking up pretty sophisticated signals, it's very easy for them to spot a trade that is trading 100 shares every 5 minutes on the turn of the 5 minutes. You know, if you see that happens two or three times, you can bet it's probably going to happen 3 or 4 times, and so you start to predict what the algorithms are doing in the market. And a lot of the high frequency market makers were just so far ahead of the investment banks. But actually what's happened over the last 2 or 3 years is the investment banks have caught right up. And so they're using many of the same electronic trading techniques to actually put in their orders for customers. So if you're sitting in an investment bank working in electronic trading, you will have algorithms that randomize the time that they actually insert the orders, randomize the amounts, put them into different markets before the other markets, work out which is the fastest reacting market and go to that one last, so you can hit someone across 4 markets in one. So really what the financial markets are a sort of mathematical, electronic and trading war between different computer setups in these electronic trading markets. So there really is a tremendous range of work in terms of building models, analysing models, implementing models, managing the P&L, trading P&L through the day, in terms of how you can use the techniques. And as I say, it started in equities and it's going to go through every asset class in varying speeds. So digging in a bit more now. So if you're building an electronic trading system, what do you care about and why do you care about it? So one of the key parts is what is often referred to as your alpha model. So this is trying to actually look at the data and work out the future value of a stock. And depending on the volume of the stock and the speed of your processing and the frequency of trading, you're trying to work out how that stock will move. And as I say, there's a trade-off between the speed and the complexity of what you can do. The market data processing is also important because you're one of the most pertinent things to your model is what's just happened. So the most recent information is very important. So you're always looking at trades and what's happening in those trades, but you're also looking at correlations, etc. So there's an awful lot of data being processed in real time, and also the models are back-tested over thousands and millions of ticks of data over many days to just look at how patterns have broken down, reacted, changed, etc. So there's in this smaller confined world, there's a big data project in just analysing market data and how it's used. Then the risk model is important. So you've got one thing now that is working out how they think each stock is going to move over the next few seconds or few minutes. There's some things then saying, right, I'm long, I've bought this position, I'm short this position, so I've sold that position. And there's something looking at the P&L all the time. And bear in mind what you're doing here is plugging computers into the market and letting them run. And so you've got to build your risk management above that layer of computers, because whilst you do have guys sitting there watching them, really they're just trading too fast for you to intervene and say, yes, I do want to do that trade, no, I don't. So you're letting it run. So the risk management model is very important to only look at the P&L, and P&L is a great thing because this is not like you're doing a swap trade where it's out for 30 years and you value it once a day and see what's happening at that day. This thing's going on all the time. If you're starting to lose money very quickly, you're getting lots and lots of small trades, you're starting to lose money, it's one of the things, it's a sure sign that your model's not doing very well or it's gone out of date or something similar. So real-time P&L, real-time risk is important. Portfolio construction, I'm making money in Apple, should I put more money into it? I'm making money in this. Now, many of these markets can absorb an enormous amount of trading, but sometimes in thinner stocks, you can find that you're over allocated to that and you're actually crushing that market yourself because you're trading so much in it. They have lots of things in there to stop them trading against themselves, for example, because they might have multiple models running as well. The execution model, so okay, now we've worked out where we think the stock's going. We're sitting under a risk model. We've allocated money. We've said, right, we want to put 10,000 euros into this trade. We've then got to decide how we're going to trade. And so you've got various ways of doing that. Now, typically in a market, as the bid offer spread that I put up at the beginning, what you're doing there is posting to the market. So you're putting up onto the market, I will buy at this and I will sell at this price. Now, you don't have to do it that way. What you can do is you can remove liquidity. So what you can do is, if someone's saying that they will sell at this price, you can be the buyer against that stock. So if you're posting liquidity, you've basically got to wait until someone comes along and trades with you. If you're removing liquidity, you can trade at your own volition. And so, but it might cost you more in terms of giving away the spread to the market, and it may cost you more in fees as well, which I'll come to. And also, what's the style? You know, how are you trying to trade over 5 minutes? Are you trying to trade over 5 seconds? Are you going to try and trade everything in a hundredth of a second or a thousandth of a second? So you've got to work out the style. And again, if you flip this and you're on the investment banking side, you might be working with clients and you'd say, look, this order is better for your style of order. So if it's a very big order, we suggest you use this type of model. Or if you're spreading this order out and you've got small orders, this type of model might be more relevant. If you want to get executed in half an hour, use it like this. If you want to get executed over the whole day, use it like this. So as I say, the electronic trading is not just market making, it can be on the sales and trading side as well. Transactional costs are also important. Really, we made our initial moves in the market by being basically 10 times cheaper than the incumbent exchanges because we automated so much. I mean, we're 10 times faster as well in terms of processing, but 10 times cheaper. And when you're looking at all of the processing costs, it's no good being in a situation where you make yourself £100 on a trade through the trading, but then spend £150 settling that or trading it. So a good example of that is that sometimes say you wanted to trade 1,000 euros or 5,000 euros, you are better off hitting one 5,000 euro trade because you'll probably pay only one trading fee, one clearing fee, one settlement fee. If you bump into 5,000 individual trades, you're going to have to settle 5,000 trades. And so all the time you're trying to look at the balance of your transactional costs as well, because you can blow the transactional costs in an ill-configured trading strategy that works for all the other things. So all of what we've just described is for trading Vodafone. Yeah, so that's just for trading Vodafone, a single stock at a single price at a single instance, on maybe across multiple markets. You want to notch it up a bit, you start looking at the options market. So now, and basically we were trading there, with all the things we've just talked about. Now if you're in an environment where you actually have an option structure as well, so you've got the option math, which takes into account the strike price that you've got and that deviation from the current market price, the term structure here of what you're doing. So you're not only trading spot or right at the market, you could be trading out. I mean, this is Apple. This is trading out effectively, you have 2.5 years up here. And then the market itself, this is implied of a volatility. So this is observed volatility in the market for the market. And this is, if you've not looked at options, this is what you refer to as an option smile. And this is really the surface. Now, if you think about the modelling involved there, down at almost each of these lines and across each of these expirations, you could have an individual price as well, affected by all of those things, plus how volatility is happening, time decay of the option, etc. So some of the options markets are just immense calculating problems, because actually each of those individual parts of the market have, you're trading them as almost individual stocks. So you could treat an option trading out here as an individual stock, but obviously they're highly correlated, because you've assumed a surface, you've assumed term structures of interest rates, all sorts of, you've assumed a volatility structure in that. And so then you sort of get it, your risk management becomes a lot more complex. It's not just pull out of that position, it might be pull down 200 positions in one stock in one go. And so it just really ratchets it up, the whole complexity of the trading, the data processing problem, the modelling problem as well. It's great stuff if you like maths and modelling, so if you don't, I'd stay away from it. So when you start to look at the environment in which you're working now, and so this is I guess the microstructure, the environment you're working in. I mean, it really is that the sort of latest systems hardware, typically, you have to make it very scalable, because you really have built it for, we're usually sitting there and take our worst day ever and have at least double that capacity available at any one time, because the market spikes enormously. And so you can find your heaviest trading periods hundreds of times more volatile than the, or more demanding from a systems point of view than the lowest period. Because And that doesn't necessarily even correlate to the number of trades that are going on, because people will be putting up quotes and changing quotes all the time. And when one quote changes, another quote will change, and you might not have even traded anything and the quotes will change. And it's got to be ultra reliable as well. I mean, because you've got positions out there. A lot of the markets like ours, if we lose a connection with with someone, we'll automatically cancel away all their orders. If that doesn't happen, you can be in a serious position, because all your orders are in the market still, saying I will buy or sell at this price, and the market doesn't care that you're not connected anymore, and it will start filling all of those orders, and you'll get stuck in a bad position. I don't know if any of you saw what happened to a company called Knight in the US in the last year or so. Effectively, they ended up in a bad situation because they had a test system connected to the live market, and basically got filled with an awful lot of orders that had come from a test system. That's how not to advance your career. So it's in terms of what you're trying to do, you're really trying to build adaptable models, but make them fast. So the sort of things you've got to understand, I talked about transaction costs. There are lots and lots of different order types, and by order types I mean, for example, you can have an order that posts liquidity, just like we were looking at, so that was how you would show a bid or an offer in the market. You can have ones that don't post at all, they just come and remove liquidity. You can have ones that are posting but you can't see them, they're the hidden orders. You can have orders that have a part of their liquidity that you can see and part that you can't, and it reloads itself into the market. You can have orders that are pegged to different prices in different markets. So there's lots and lots of different order types, and understanding how they work and how they can interact is part of the art of this. And that's also a function of the market microstructure, which is how you describe the framework of exchanges and other trading venues that you're working in. So the US market has got a different market microstructure from Europe. So again, you've got to understand the rules of that to know how orders are going to find their way around the market. A quick example of that, in the US, it's the exchange's obligation that if it can see a better quote, if it gets an order in, and if it can see a better quote on another exchange, it sends it to it. That's the rule. It has to do that. In the Europe, that's down to the broker. So we don't have to send them anywhere else. The broker has to work out the best place to send them. The mass management of individual securities I touched on. The better you can manage, the more granular your models, the better. But the more of a control framework you actually need. And excuse me. I really saw that over the last few years, where the firms, initially the firms that were doing really well, just got the technology sorted out. So they had the fastest boxes, the fastest connections, etc. Gradually, that became sort of very, very much common fare. There were a lot of firms that could get pretty near each other just by buying the same boxes, the same cable routes, etc. So the firms that really started to do well are the people who could manage the the very large amount of securities and the models for that. Now, on the flip side of it is that in markets like ours, we're also monitoring all these guys. And so we're monitoring them in very hard. So again, we always have the inverse of this, is that we're taking in all these messages. We're very highly automated in terms of how we look at it. We're looking for trading patterns, etc. We have very high message throughput. If we see something that looks bad, and I'll come to what bad is, what we can do is actually just stop a particular stock, just replay that, look at all the trading interactions that say are happening in milli or microseconds, and actually say, okay, this guy did this, and this guy did this, and that firm did that, and just work through whether there's been a problem or not. And we use a lot of pattern recognition in that, and we can even recognize patterns in other markets now that are not our exchange, that are exhibiting those same characteristics, even though we can't see which firm it is. We've caught out firms that we've closed down on our market and have just moved to others, and we've caught the same pattern. So why are we surveilling these markets, to use a dreadful phrase? What we're trying to do is stop bad behavior in the markets. The equities markets are very highly regulated, and some of these things will start coming to other markets, because it's just like, when it comes down to it, it's just like a normal market. So if someone just misleads you, that's wrong. So how is misleading people work in electronic trading? So there's a number of ways they can do that. So for example, what they might do is, if you remember that screen we were looking at for Novartis, if you saw a single bid on there, and actually a whole load of offers, people willing to buy at higher and higher prices, you might think, well, you know what? The market thinks this is going to go up. I should be buying into this now because the market thinks it's going to go up. Now, some firms who they get closed down for doing this, they might try and put up all one side of the book, and then as soon as the deal's done, they pull that away and drive the market the other way. So you're left with a position you thought was going to be a good position because you thought the market's gone up, and the market's just gone away from you the other way. And then they come back and you try and sell it, and they hit you, and they've taken a profit out of you. So all the time we're watching out for the interaction of firms like that. Firms, sometimes deliberately or accidentally trade with themselves to create activity. We've got to watch for those sort of things. So there's lots of things that you'll hear if you hear people calling spoofing or layering. Those are the sort of techniques that we're watching out for to make sure that it's a good market. People can trade against each other, but it's a difference between sort of fraudulent behaviour and acceptable market trading area. It's pretty rough and tumble, but you still don't want people misleading the market. So even within a single market, there can be an awful lot of going on. So this is our European exchange here. So what we've got here is CXE Litbook, BXE Litbook. They are two books where you can actually see, say for example, Novartis trading, just as with those pictures. But they were two, but we can have two different books trading exactly the same stocks on the same exchange. And the reason we do that is we can price them differently. So on one market, we give rebates to people who post liquidity. So why would you do that? Because what it does is if people put goods in your shop window, it attracts people to trade with you. And some people get more theoretical about it, that if you're effectively posting liquidity, you're taking risk. Because effectively what you're doing is granting people an option to trade with you. So for the amount of time you're saying, I will buy at 100, you're granting everyone else the right to sell into that at 100. So do you want to rebate people for that? And so what we do in one book, we rebate people for that, and we charge a higher price if you want to take that liquidity away. In the other book, we don't give any rebates at all, but the price to remove liquidity from that book is a lot lower. So some people are just attracted to that because they want to try trading at a low price. The dark books are books where you can't see any prices to buy or sell Novartis. And this is dating in the dark. So what people are doing is putting up, I would like to buy at this, sell at this. And if they happen to bump into each other, what we do is we fill fill those trades at the mid price between the bid and the offer. So it's just a different type of trading. Now, why would you do that? Well, you might get a better price than trading at the bid or the offer, depending which way in the market you're trying to go, but you're not going to trade as quickly because no one knows you're there. So you have now again, because no one knows you're there, you're not giving away your position to the market. So if the market's trading at 10,000 euros a trade, and you've got 100,000 euros to see, if you say, right, I'll buy at 100,000 euros, the market would sort of suddenly move and go against you because they know your position. So sometimes people put bigger positions into these books, knowing that they might get some price improvement. The cost of that is they can't be as aggressive about their trading. So if you're a market making side of things, you're trying to look for opportunities in these books. If you're on the banking side of things, what you're doing is actually saying, well, okay, I might try here, and if I'm not filled here within 10 seconds or a minute or however, I'll go over here because I know I can get filled over here. But when you're doing that, the market could also move against you. So you could end up, the price that you thought was a good price there can actually move against you as well. These other things are just the banks themselves can run markets. So the investment banks themselves run markets. So we handle all their market data for them, making sure their market data gets out to the market. They can trade over the counter OTC, so you can have trades that might be done electronically, but they're done totally within the bank's books. And we report those trades and distribute the data to the market. And then other people run markets as well, and we take care of all of their data. So even when you sort of say, right, okay, I've got this, I can understand I've got this in multiple exchanges. Actually, in the exchanges, there's still alternative trading. There's a lot of regulation around these markets, and it's worth being conscious of them, and that because they do directly affect what you're doing in electronic trading. So there's debates about how long you should rest an order. So when I'm making that bid or that offer, it's how long should I show that quote for. People were concerned that it was physically impossible to hit some quotes because they were up there for such a short period of time, because a market maker was sending a quote to a market, getting hit on another market, so sending a cancel, and the first quote was getting there and they were cancelling it before anyone had even seen the other quote coming back. So how do you manage those sort of things? Order to trade ratios. Is it right that someone changes the price 1,000 times on an order every time they trade? Sometimes it is, sometimes it isn't. And so you've got to manage that. So to give you an example, when we were going into the Spanish market, we had no market there at all. We had very bad order to trade ratios, so the price was changing a lot. But that was because the market makers were doing a fantastic job. They were keeping the prices up to date until we could get flow to interact with them. Who's going to approve the algorithms? Are you allowed to have predatory algorithms or not? What's the definition of a predatory algorithm? If you're a market maker and you get benefits for that, do you have obligations that you've got to fulfill? So have you got to make that price for, say, 90% of the day or 99% of the day? And also, there's a lot of politics and almost behaviour change between some people who want to introduce a financial transaction tax, which is just a terrible idea, but they would like to do this. But this would effectively charge for every transaction, which means that ultimately those fees would probably end up getting charged to pension funds, or if you're a retail investor, to yourself.